Well, shoppers were not scared away by surging inflation in January. That's our top story today on the Wall Report. I'm your host, Greta Wall. The Census Bureau reported today that retail sales jumped 3.8% in January, sharply higher than expectations for a 2.1% increase. Now, that was led by a surge in online spending, which rose 14.5%. Americans also spent more on furniture and decor, with those sales rising 7.2%. But spending at restaurants and bars dipped 0.9% as more people stayed home at the height of the Omicron wave in the U.S. That was also reflected by a 1.3% drop in gasoline sales, despite those prices surging 40% year over year in January. Retail sales were up 13% compared to January 2021, but it's important to note this data is not adjusted for inflation. Higher prices did partly contribute to the jump in retail sales last month, as that metric is measured based on total amount spent, not number of items sold. Now, meantime, inflation and supply chain issues are weighing on home builders. The National Association of Home Builders Sentiment Index fell 1 point this month to 82. Now, that reading was in line with expectations, but it's the second straight month of declining confidence. Builder sentiment about current sales conditions rose 1 point to 90, but sales expectations for the next 6 months fell 2 points to 80, and buyer traffic was down 4 points to 65. Builders say they're waiting months to receive key materials for new homes, including cabinets, garage doors, countertops, and appliances. Lumber prices are also back on the rise, and NAHB estimates the cost of lumber has added nearly $19,000 to the price of a new single-family home. Now, higher prices coupled with higher mortgage rates means more buyers are being priced out of purchasing a home. And as home prices continue to rise, the average mortgage size in the U.S. just hit a new record high. New data from the Mortgage Bankers Association shows the average loan size jumped to $453,000 over the last week. Now, total application volume fell 1% as rates continue to rise. The average 30-year fixed rate rose to 4.05% last week from 3.83% the week before. This is the first time that average rates have been above 4% since all the way back in 2019. And as those rates move higher, refinance demand has tumbled. Refinance application volume fell 9% last week and was down 54% year over year. Airbnb shares, though, were up more than 6% today after strong Q4 earnings and Q1 guidance. The home rental site reported earnings of 8 cents per share on $1.53 billion in revenue last quarter. Now, that beat analyst expectations on both the top and bottom line and pushed full-year revenue to a record $6 billion. The company expects their strong performance to continue, forecasting Q1 revenue between $1.41 billion and $1.48 billion. That beat consensus estimates for $1.24 billion. Now, Airbnb also said it expects bookings in the first quarter to exceed 2019 levels as the business continues to rebound from the pandemic. Long-term stays have become more common as work from home allows more Americans to travel. Airbnb said stays of 7 or more days now represent nearly half of all gross bookings, up 15% compared to 2019. And while Airbnb is riding high on its strong earnings, Roblox shares are down more than 24% after a big earnings miss. The online gaming company reported a per-share loss of 25 cents in Q4 versus analyst expectations for just a 12-cent loss. Bookings in the key holiday quarter also fell short at $770.1 million. Wall Street was looking for that number to come in at $772 million. Now, Roblox reports bookings as a better measure of revenue, as it also includes what's called deferred revenue. The company has its digital currency known as Robux, and earnings from that can be considered deferred revenue. Now, Roblox also reported a decline in daily active users and hours engaged in both the US and Canada. The company's business boomed during the pandemic as kids were stuck at home, but investors are now concerned the business won't hold up as life returns to normal. And the major indices are all down today as markets continue to monitor the tensions between Russia and Ukraine. NATO warning today that Russia is increasing its troop presence at the Ukrainian border, despite Russia claiming on Tuesday that it had started pulling its troops back. The NATO defense ministers are set to meet in Brussels today to discuss this conflict. Russia is demanding that Ukraine never be allowed to join NATO and that NATO decrease its presence in Eastern Europe as a whole. President Biden vowed the U.S. would defend its NATO allies in a speech at the White House on Tuesday and said the U.S. is committed to defending Ukraine's sovereignty as well. And as those tensions simmer, oil prices are back on the rise today. The VanEck Oil Services ETF is up about 3% in today's session, hitting the highest level in 2 years. Year to date, the fund has surged more than 35%. And as the market monitors those geopolitical tensions, Wall Street is also keeping its eyes on the Fed. The central bank releases the minutes of its January meeting at 2 p.m. Eastern Time today. Now, the market is eyeing this report for more guidance on the bank's plans to tighten monetary policy. So far, the Fed has officially penciled in just 3 rate hikes this year, but the market is expecting as many as 7, and several Fed officials have struck a much more hawkish tone in recent interviews and speeches. The bank meets again March 15th and is expected to enact its first rate hike at that meeting, and it could be a 0.5% hike instead of just 0.25%. Let me know how many rate hikes you see the Fed doing this year in the comments. Personally, I'm on the side of 7, one at every meeting left this year. I'll see you all back here for the Wall Report tomorrow. Be sure to hit that subscribe button and the notifications bell before you go.